You ever look back at a financial decision you made and just shake your head, wondering, what on earth was I thinking? Yeah, it happens to the best of us. Today, we're going to pull back the curtain on the psychology that's secretly running the show, the hidden forces inside our own minds that shape every choice we make with our money. And it's a huge question, right? We all like to think we're logical, rational people, especially when it comes to our own cash. But the truth is, some of the smartest people in the world make financial moves that, in hindsight, seem completely bonkers. So what's really going on in our brains? Well, the answer is in this super fascinating field called behavioral finance. It's basically where psychology and economics smash together. It gives us a map to understand all those little mental shortcuts, emotional triggers, and hidden biases that are secretly in the driver's seat when we make financial decisions. All right, so first up, let's dive into the biases that come from the outside world. Think of these as the mental traps that get set for us by the information we see, the numbers we're shown, and, of course, what everyone else around us is doing. First up is a really powerful one, anchoring. This is our brain's tendency to just latch on to the very first piece of information it gets and use that as the benchmark for everything that follows. And the crazy part is, it works even if that initial number is totally random. Here's a perfect example from investing. Let's say a stock used to be flying high at $100, but now it's trading at 30. Your brain instantly anchors to that $100 peak, right? It makes the current price seem like an unbelievable bargain. The problem is, that anchor can totally mislead you, blinding you to the real reasons why the price fell in the first place. Next, we've got the gambler's fallacy. This is that gut feeling, which is totally wrong, by the way, that what happened in the past in a random situation can somehow influence what's going to happen next. You know, you flip a coin, it lands on heads 5 times in a row, and you're just convinced that tails is due. That's the fallacy right there. And you see this all the time in finance. An investor watches a stock climb for a solid week and thinks, well, this streak can't last forever, it's got to drop soon. And boom, they sell. They're falling for the trap, thinking the streak itself makes a downturn more likely, when really, every day in the market is its own separate event.
Ah yes, herd behavior. This one is huge. It's that deep, primal instinct we all have to just follow the crowd. When things are uncertain, our first impulse is to look at what everyone else is doing and assume they know something we don't. This is the engine behind massive market bubbles and spectacular crashes.
So what's actually driving this? Well, it's a whole cocktail of powerful psychological forces. You've got social pressure, that deep-down desire to fit in and be accepted, and of course that little voice in our heads that says, hey, a huge group of people can't all be wrong, can they? And this instinct is at its absolute strongest when we feel like we're in over our heads. Okay, so that's the outside world trying to trip us up. But now, let's look in the mirror. Let's talk about the biases that are already hardwired into our own brains, the mental shortcuts and ego traps that we carry around with us every single day. This might just be the king of all biases, confirmation bias. Once we get an idea in our head, let's say we decide a particular stock is a brilliant investment, our brain essentially becomes our personal hype man. It goes out and actively looks for any piece of evidence to prove us right, while conveniently ignoring or explaining away anything that suggests we might be wrong. Yeah, it's almost like we put on a special pair of glasses that only let us see the things we already agree with. We get really good at finding news articles and expert opinions that back up our position while dismissing any contradictory evidence as fake news or biased. We literally build our own echo chamber, brick by brick. And make no mistake, this is a really big deal. Confirmation bias leads directly to some terrible decisions because you're operating in a skewed reality that you built yourself. When you only pay attention to the good news about an investment, you're essentially flying blind, completely unaware of the risks that are right in front of you. Next up, we have hindsight bias. You probably know it as the I knew it all along effect. See, after something happens, our brain is sneaky. It goes back and kind of tidies up the past to make it look like the outcome was completely obvious and predictable from the very beginning. The dot-com bubble is the classic example. Now everyone's a genius, right? Oh, it was so obvious that was going to crash. But think about it for a second. If it had been truly that obvious to everyone back then, how did the bubble get so huge in the first place? It couldn't have. That's just hindsight bias playing tricks on our memory. And this is where things get really dicey, because there's a direct chain reaction. Hindsight bias, that false feeling that I saw it coming, starts pumping up our ego. It begins to fuel overconfidence. We start to think, wow, I'm pretty good at this. My ability to predict what's going to happen is way better than average. Which brings us to a critical warning. Overconfidence is just about the most destructive mindset an investor can possibly have. Seriously, it makes you take on way too much risk, ignore flashing red lights, and completely underestimate the role that pure dumb luck plays in everything. So after going through all these mental traps, what's the solution? Look, the goal isn't to become some kind of perfect, emotionless investing robot. That's impossible. The real goal is just to see our financial blind spots for what they are, to become aware of them. So let's run through that rogues gallery one more time, shall we? We've got anchoring on the first number we see, the gambler's fallacy, following the herd, only listening to what we want to hear with confirmation bias, and then hindsight bias leading to that dangerous overconfidence. These are the powerful forces we're up against.
And this brings us to the absolute core takeaway of all of this. The secret to making better financial decisions has nothing to do with being smarter or having a higher IQ. It's all about developing self-awareness. It's having the discipline to just hit pause for a second, question your own gut reaction, and ask, wait a minute, which one of these biases might be pulling my strings right now?
So, I'll leave you with this question to chew on. Now that you know about these hidden traps, which ones do you recognize in your own decisions? Because just being able to spot them, just that awareness, that's the first and the most powerful step you can take toward making smarter choices with your money.